notes. Um, you know, sometimes we say, we're honored that you guys chose to invest an hour of your time here with us. We're committed to giving you a good return on that time investment. I also want to say I have a lot of content to share. This is an annual market update, and this was an interesting year. I should say last year was an interesting year. Most of you know I get a little excited when it comes to market stats, but we will absolutely send out slides after so you can, sort of sit with them a little bit or share them out to socials. All we ask is that you cite us. It's literally the only thing that we ask. With that, let's get cranking. I've been working on my visual, so hopefully you guys will notice that. As some of you know, we like to start a little bit on the lighter side. So being that we're so close to a new year, remember the clients who said they wanted to wait until the new year? There you guys are, 12:01 a.m. Technically, it's the new year. I want to mention, most of you know this, but we have an incredibly robust reporting environment. Fast Stats is what I bookmark. This is what I would recommend you bookmark so you can hop into our local market updates, the weekly report, the monthly is, annual report that's coming out next week, foreclosures and short sales, which we'll talk about very little bit. Also hop over to the market data section of our website. There's Today in the Market, and then there's our YouTube channel and everything else. So there really is a lot of content that we produce for you guys, and we just want you to consume it. That's all. And to leverage it with your clients and to help you grow your business and be more planful around stuff like that. Guys, why do we care about any of this? Sometimes I put this slide toward the end. You talk about all the market stats and all the update, and then you'll say, so here's why we should care about this, but I've moved it to the front. Here's why you should care about this. If the question is a month's supply of inventory, it can answer, if the stat is month supply of inventory, it can answer the question, are we in a buyer's or a seller's market? How do the different property types compare? We've got townhome condo data versus single family. We're going to talk about that. Prices, up or down, median sales price or price per square foot. How long will it take to sell my house? I've heard some homes are selling in 8 days. Well, for homes priced above 600,000 in Bear Path that have, 5+ bedrooms, it's a little more like 36 days. So stuff like that. How much of my asking price will I get? Percent of original list price received. Basically, this is a list and a way of saying we've got a stat for that, right? We've got a stat for that. So as we do, we very much encourage you guys to kind of be the expert. You already are the expert, but there's more that you can do to bring some of this stuff into your daily processes. Today, I get to talk about the love of my life, residential real estate. I think she nailed it with her face, just the nose and the lips kind of okay. Guys, let's go all the way back to the 1960s. Some of you were around back then. I was not. Neither was Jackson nor Alicia, but I know some of you were around back in those days. And I just want to show you guys, what's happening with seller activity going way back over half a century. So what's been happening with new listing activity, supply coming on the market in blue versus sales or demand or homes flowing off the market in red. I'm going to be pretty mindful of time here. So I will show you guys kind of what I'm thinking about and the way that I look at this. I see divergence here where we saw a lot of new supply coming on. You know what I realized? I don't think you guys can see my mouse. I look here when we saw a lot of supply coming on, right? New listings coming on, and I see this big increase, but then I look at demand and I say, well, it was growing, but not quite to that extent. And then look at the housing bubble right before our crash. You can really see supply levels increase. A lot of that was condos as well as new subdivisions. And what I see here is, oh, okay, demand is coming along for the ride as we got a little creative around financing, but then demand sank while supply was high. So what happens in these kinds of cycles, you guys? When you see supply growth without demand growth, prices almost always fall. Here, we had supply growth without demand growth, prices fell. What's going on here? How do we contrast those last two cycles with this current cycle? the way we think about it, the way Jackson and I and we talk about it here is, we used to have this divergence, right? Here I go with my hand gestures again. We used to have this divergence, but what do we see now? It's actually been, instead of a divergent, oh, now it's not looking, not so good. Anyway, I'll stop with that. It's not a divergence, but everything, both buyer and seller activity are moving down in tandem. So instead of diverging, they're both sort of downshifting to a lower gear together, which has meant what? Look at the gap, you guys. So notice how big the gap grew here. Look at this gap between supply and demand. What do you notice here? Everything's lower, but the gap is actually about as tight as it's been. And that's why we only see month supply go from what, 1.5 to 1.8 or 1.9 months. So not the change that I think most of us were expecting. The Great Mean Reversion, another one of my favorites, all the way back to 1960. And I have sort of little notations here, sort of market cycles or some economic dynamics. So 70s stagflation, inflation, and then 80s hyperinflation, right? So look at price growth kind of flattening out. Look at the bubble. 1990s was really a strong decade. There's your 05, 06 bubble. There's your 08, 09 crash. There's your 2010s recovery and the inventory shortage. And then here's the 2020, 2021, and 22 kind of boom. And then there's 23 where you can really see prices leveling off, not down, but the rate of price growth has really slowed notably. All right, diving a little bit deeper for all the dog parents out there, pet parents, I should say. Ooh, what's hiding behind these little chart pill capsules or whatever? Showings data, shall we? All right, so this was kind of a post-COVID thing where we were monitoring this really closely for obvious reasons. And we've kept doing it, ever since because of the positive feedback that we've gotten. What was it? Maybe mid or second half of last year, we threw in rates, right? So now you guys can look at change in showings in blue, combined with the 30-year fixed rate mortgage in dotted gray. Right. So here, there's your 8%, you guys. There's your 8%. And here we are now at what, 6.6, 6.7. You can see rates were, sub 6, or 6-ish, it looks like, beginning of last year. Guys, you can't make this stuff up. Look at how beautiful the data is. As soon as you see rates starting to ease, boom, you see showings respond. Look at that. And look at this divergence that we see. As rates have eased from 8 to 6.5, 6.75, we have seen showings up 40, 60, 80%, kind of depending on, the week. This week was pretty cold, and so, maybe we won't reflect quite as many, but, December was really warm, and so was the first week of January, memory serves. So really interesting, guys. Inverse relationship here. Rates down, showings up. Duh. I'll take things that are obvious for 800, Alex. Anywho, thought I'd throw that in there anyway. All right, so showing activity by price range for the first week of this year compared to the same first week of last year. You can look at the levels. That's interesting. I tend to focus on the change down here. And one thing I see is plus, 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 plus. 9 of 9 price ranges had more showings the first week of this year compared to the same week last year. That's pretty good. I think that tells a story, that paints a picture. Interesting to dive a little deeper, and we see the biggest gainer was actually an 800,000 up to 1 million, followed, I guess, fairly closely by our luxury segment, over 1 million there. So that was the number, but what about the share? So this said there were 3,600 showings, on this kind of on product in that price range during that time. But this answers the question, what percentage of overall showings occurred in each price range? So you'll see some similar patterns, but it is technically asking and I guess answering a different question. So no surprise, you guys, we see the bulk of our activity, over 1 in 4 deals, happens between 300,000 and 400,000. Yes, that's obvious. The median is what are we, 370, 368, 375-ish. So we're right in the middle. We're right in that range. Again, we're going to touch on luxury a couple times today. Look at these gains, you guys. These are pretty significant. The share of showings between 800 and a million doubled from, right, not quite 1.12 to 2.24 would have been doubled. We're pretty close. And look at million plus as well. Pretty noticeable gains up there, which makes sense because those folks are less rate sensitive, right? They're not as rate sensitive. New listings by price point, see some declines in sort of the affordable segments. Start to see some gains in supply as you get over 250, especially as you get over 350, minus 750,000 up to a million. Sometimes you'll just see wonky things happening. And then million plus, definitely see some gains there. Sales, or I should say signed contracts, they haven't all quite closed. I think this tells a little bit of a more clear picture where you see declines in demand everywhere under 250, kind of even to flat between 250 and 350, and then pretty noticeable gains as you get over 350, and especially over 500,000. I guess million plus not having the strongest turnout, but 5% up. And you guys can kind of see where the increase in sales has been, where that demand has been. All right, 215, being mindful of time. All right, so now we're getting into the meat, you guys. We're really getting into the meat of it. We're going to look at all of our major metrics, and we're going to trend them back to 2003. New listings, seller activity, down about 12.5% from last year after a 10% decline from 21. You guys can see, I wish I had different news to share, but new listings are at a 21-year low at a minimum, because that's when the North Star data is is valid as of. And it's likely well before then, you guys. Hard to say exactly when, but I think it's as low as it's been since at least 2000. But all I can say with 100% certainty is that it's as low as it's been since at least 2003. Well, why aren't we listing? Well, could it have anything to do with the fact that 70% of outstanding mortgages are financed below 4%? I would say that it does. I would say that it has a lot to do with that, right? So in green, you got sub 3% loans. Oh, sorry, blue is sub 3, green is 3 to 4%. So blue and green together are both sub 4%. Pretty big share, 7 out of 10 financed under 4%. This is why we talk about the golden handcuffs, and we've shared this slide for the last, I think, 3 or 4 webinars, when people are feeling handcuffed to their home and they're feeling locked in, the lock-in effect. Married to their interest rate, some say, and sometimes we joke, and this is just data. This is just the data. If you're married to your interest rate, this country has a 50% plus divorce rate. So if you think you're married to your interest rate, just give it a few years, and you might find that you don't share as much in common anymore. Different interests. Pending sales, you guys, look at COVID, right? Look at bubble levels, COVID levels, easily above that. Look at the little tax credit bump. Always interesting to see, some of the effects of different policies on the market data. So pendings, oops, forgive me. I told you I get a little excited sometimes. Pendings down 20%, followed by another 15% decline, put us at about 44,500. That is not quite as low as it's been. It is above these lows, but it is definitely in a different place than where we were. All right, didn't mean to jump the gun there. So let's go back to October. And the reason I'm picking on October is because it had an interesting pattern. And I think this pattern is present, for almost every month of last year. But for whatever reason, October really, it's going to help me paint this picture. So check this out. Look at sales. Look at that nice, fairly linear rise in sales. And then look at the COVID bump and the correction. And now look at the rate decline and soon the correction. So guys, what does this gray trend line represent? And I know the market doesn't move, linearly in a linear way, but this is the long-term trend. So like that, one of my first slides was the great mean reversion, and it says over a long enough time period, everything sort of reverts to the mean. It's like gravity. right? The moon can't escape the Earth's orbit, and Earth can't escape the sun's orbit. And, sometimes we get a little further, but then we're kind of pulled back. Stock market, the same way. Sometimes we get a little excited and then we kind of pull back. But overall, there's this trend, and you guys can kind of see that trend. So we just witnessed this, and now we're here. And what's coming over the next few years is very likely going to be something like this, where we get back on track. Timing is a little bit unknown, but the fact that we'll get there is pretty much a given. Year over year change in sales. Sales declines after the bubble burst. Yeah, there was your tax credit, and then you kind of had to find the bottom. Mostly up, couple downs, couple downs, couple downs. But here's your big declines, you guys. And look, this started at the beginning of 22 when, the inflation reading, CPI numbers and the Fed really started to hike rates. So look at these declines. It looks like they reached their peak, or maybe their valley. It looks like the declines hit the worst levels, hit the most extreme levels at the end of 22. We still showed declines throughout every month of 23, but notice how those declines have eased a little bit. So we are not blue. We are not above the line. There's our zero line. But what is encouraging, and you know what? I think I can actually draw. I think I can draw things. What's encouraging is that we're starting to turn a corner. And before we can start to put in some of these plus bars, these blue bars, we have to fully kind of get above zero. And it looks like we're getting close. And if this year, if we see rates high fives, low sixes, I suspect we'll get above zero. If not the first quarter, then I would think the second. But again, hard to say for sure. Days on market times. What's going on here? 100 days, 115 days to close. Or sorry, this is a list to under contract, not list to close. Well, what do we notice? I see 18. I also see that's a 28% increase. I also notice that 18 is the same as this 18, right? 18 is 18 is 18. So market times are definitely up from 21 and 22, but they're on par with 2020 levels. And homes are actually selling faster than the 2 years pre-COVID. Well, I guess every year going back to 07, minus the 21 and the 2022 sort of exceptional COVID frenzy years, if you will. Time, the clock is ticking. They shouldn't call you overpaid just because you sold their home fast. That's exactly what they wanted. So sometimes we have to remind them of that. Median sales price, you guys, this is one that everybody likes and everybody follows. Hang on, let me do a quick check on chat here. Sarah had a thought. Showing activity week ending 115, under 250K. It's hard to say. People may not have felt like coming out. That's a little bit of a thinner market. Rates may not have been exactly where people want. And then maybe the supply just isn't, if there's not enough listings to show, there's not enough supply, so showings will be down. So there is a multitude of reasons there. And then let me hop in chat. Oh, okay. All right, median sales price, guys. Back to the meat. Median sales price, peak at 230. Kind of hit our valley of 150. Here we are at an all-time high of 368. You guys will notice. Once I get my act together here, you guys will notice this 1.5% increase is noticeably lower than every year since we had a decline, right, in 2011. So it is much lower than, 14, 7s, 5, 7, 7, 6, 9, 11, 7, 1.4. So this really does show, the impact of these rising rates. By the way, home prices actually fell in real terms, right? Home prices fell last year in real terms because they only grew 1.4%, but to adjust for inflation, you'd have to take down the 3% plus due to inflation. So they actually did fall in real terms. Yeah, I think I zoomed in a little bit, just so you guys can kind of see that, really see that change in this leveling off. Yes, I know what all the comps say, but my house is special. I have the maple cabinets and the parquet floors. Parquet floors. It looks like you're asking $368,000 for your house. Best I can do is 125 grand. But first, let me get my guy down here. Take a look at it. You got to have some fun with it, guys. Thanks for humoring me on that. Year-over-year change in price. So we looked at year-over-year change in sales. We're looking at year-over-year change in price. Price growth during the good old bubble days. Price declines, after the bubble burst and during the Great Recession. I don't know why I keep going back to this. It's just so interesting, that tax credit period that really actually brought enough demand into the marketplace to push prices up during a time when prices were kind of softening, right? Well, definitely softening. I won't geek out on everything, but just know this, you guys, right? Look at how much price growth has slowed. It has slowed pretty dramatically. This is interesting. I know in the teaser for this, Jackson and I sort of teased you guys and said, come find out, which month. There was technically 1 month. As we've updated the data, some of these late status changes and some of these sometimes cancellations or expirations or withdrawals, it can take a few months to fully reflect that. And so we actually did see a 0.3% decline in April. And then I think we had a 1.25% decline in May. But as we see, prices were still up for the year, even though they were down for a month or two. This tracks with the nation. This is Case-Shiller nationwide, right? So 0405, there's your crash, there's your kind of tax credit. There's your investors kind of swooping in with cash on some of these foreclosures. There's a more normal market. There's a COVID frenzy, and there's the Federal Reserve really slowing things down with higher rates. There's a storyline, you guys, right? There's always a story and a chronology of events, as we say. Percent of original list price, how much of my list price will I actually receive? Back in 0405, you were looking at about 98.5%. During COVID, you were looking at 102%, or 101%. So 102 and 101. We finished off last year with 99.33%. Still pretty good, below 2020, but above 2018 and 19 levels. So, yeah, it looks like a change. It looks like a pretty dramatic change from the last 2 years. But this is why you have to go back a little bit more into the history to show where we are, where we've been, and that'll help us kind of see where we might be going. Price per square foot, I won't dwell on this one. About 195 per foot means what? Your typical 2,000 square foot house will be what? 380 grand, something like that. So just know that. But you guys, Wayzata is so different than Roseville, is so different than Shakopee, is so different than Woodbury. So this is metro wide. Your mileage may vary. All right, inventory count. Believe it or not, there was one time we had 28,500 listings, active listings on the market. We finished off December with about 6,300. As we say, I'll climb out on the skinny branches and speculate that that's a pretty big decline, right? From 28,000 down to 6,000. Saw an increase in 22, but still looking at a decline as of December anyway, as of the latest data. Again, sometimes this will shift and jiggle around a little bit. If we had, some listings that go under pending, under contract, that it falls through because of a contingency, or it returns to active status. But sometimes it takes a little while to reflect that. 7-8 months of supply, buyers markets. 0.9 months of supply, sellers market, right? 1.5, 1.7 months of supply. Still a seller's market, 1.7. I see that's pretty tied up with 2019. Right. So again, some people think we're here, 4, 5, 6, 7, 8 months, and they're going around writing lowball offers. And that's not going to be a successful strategy, just given where the market is. What's next? Price reductions. You guys like this one. We get requests for this one. Chart requests, kind of like a DJ. So what's going on here? All right. So 50% of deals required a reduction back in the troubled times. 2020 and 21, not a lot of price reductions there because everybody and their mother wanted to buy a home. We see more now, right? 22, it's about 2018 levels, in fact, below 2019 levels. So not really alarming at all, but definitely something that we're watching. And I think I've even got November next. Here we go. Guys, August, of course, 20s, November being a cooler month, more like 30. So this does change month to month. Here you can really see the COVID impact even more clearly. And then this one does show at about 36. That is technically the highest level since 2015. So maybe that's a little bit more not alarming, but maybe that's showing a little bit more of a little bit more of the truth lately. And I think that kind of passes smell test. That's what people would have expected. I love this saying. I wish I came up with it. I didn't, but I can't remember who did, which is kind of a no-no, but I'll do it anyway. I don't know who to attribute it to, but it was not me. We're range bound, you guys. We got a ceiling and we got a floor. Lack of affordability and higher rates are preventing prices from rising above the ceiling. But a shortage of supply is preventing prices from falling through the floor, right? So we're kind of range bound. We're bound in this range where, again, we can't break through the ceiling because of prices, rates, and affordability, but we're not really falling through the floor. Prices aren't really falling because of supply. So again, I find that a really useful way to think about, to sort of think about this stuff. Don't read from your slides, they say. Let me read from my slide. Pent-up sellers will create supply that should be met, will likely be met with demand from pent-up buyers. So don't expect this huge glut of listings come spring. If rates are 6 to 7, well, I should say rates could be 6 to 7 by then. I would think low 6s, 5s are possible. If that happens, you guys, you are going to see demand coming out of the woodwork, and even a little increase in supply is going to be woefully underwhelming. It's just not going to be enough. Cash deals. I know a lot of you are working with more cash buyers last year and maybe this year too already. The data shows about 17.3% of all sales were conducted entirely in cash. So about 17 and a third percent, definitely up. Folks were financing homes, it turns out, when money was basically free. People were financing homes at 3% interest, 4% interest, no problem. A lot of cash back here, some investors, right? Picking up some foreclosures, that kind of thing. Do note though, 17.3, that is the highest level since 2013. So that's sort of a 10-year high there, which makes sense with rates being as high as they've been since 2000, which is actually a 13-year high. All cash buyers nationally, always larger nationally, mostly because of places like California, New York, Florida, kind of dragging things up. Some Canadian buyers, some Chinese buyers, some European buyers, some South American buyers. NAR does have some good data on that. I wish we could track that locally. Cash deals as a percentage of all sales for million plus, only for luxury and elite luxury, not entry-level luxury. Entry-level luxury. Over 1 in 3 million plus deals are done in cash. Guys, this surprised me. I've asked a bunch of people and they've all said that almost seems low. So I gotta admit, this surprised me, but we've quadruple checked it and we've talked to people, and anecdotally, this checks out, right? This checks out. Here's your rich all cash buyer and his agent. Is this true? Is that true? Seems like maybe that's true. I don't know. Who knows? Maybe he's one of the tech guys who just works in his basement or something. Who knows? Doesn't need to dress up. More beds, please. Percentage of all sales that had 4+ beds. So the next 5 or so slides, you guys, we did update them, maybe quarterly last year. Maybe I've had them a little bit more, but I know we gave you guys a couple updates on these throughout last year. I want to bring them back because we closed out the year. And so it's nice to look at 2023 compared to all years to kind of put it in context. 42% in 2020 had more than 4 beds. I need the home office, the second home office, the home classroom, some entertaining room at home. And we've since seen that come down. And actually 39.8 is technically the smallest share since 2018. So how are buyers reacting to higher rates and how are they adapting? They're looking at 3-bed homes or maybe 2-bed condos or townhomes, right? We'll talk more about that. So just one response. Square footage, are those homes smaller? They kind of were for a year and then they're not, but they're still not back to the all-time high when people in 2020 really wanted larger homes. Don't forget, also, it was mostly single family. The vast majority of these sales were single family. Single family tends to be bigger, which brings up, I almost said the average, brings up the median. Well, it brings up both. And now we've gotten back to small gains, up 0.2, up 0.1. What do we got next? Townhouse condo. So about 27 of every 100 sales were either townhomes or condos, right? 27 of every 100 sales. That is not quite to that level that we saw during the condo bubble in 06 and the condo boom in 06, but it is the second highest level after that. And I think that does tell a story. And let's ask and answer the question, why? Look no further, my friends. Condos, 205K, townhomes, 305K, single family, about 400,000, right? Just about either side of 400,000. So what am I going to do to get my payments under 2,000 a month? Well, I might have to change the property type or the product type that I'm looking at. And sure enough, let's be clear. We didn't see this surge in condo and townhome sales, but they did fall less than single family. And so again, I think there's a story there. New construction market share, about 12%. That is still below the 14, 15%. Again, a lot of those were condos, new condos. Nice to see some lift off here. We've still got some runway ahead of us. I always give the caveat, if Lennar or whomever, if builders don't list it on MLS, we can't capture it. We can't report on it. I beg and plead with you and them, please enter these deals as comp solds so everyone can have the benefit of the data and we can have just a better, more transparent market for everybody. All right, what's up next? Yes, new construction metro-wide is only 12%. In Lakeville, it's 34.3%. And look at the jump. How about Blaine? In Blaine, also about 33%. And holy cow, look at the jump. So places with land, right? Places with land. And maybe I should say development-friendly policies and maybe regulatory environment. Maybe I should say that. We are seeing growth there. We are seeing growth. So again, a note here, it's not that new home building has surged as much as existing sales have slumped. And so that means even the same amount of new home sales are making up a larger share, but of a shrinking pie. So I know that's a little wonky, but so just keep that in mind as we're thinking about this. All right, distressed market share. What's going on with this one? You guys believe 50% used to be either foreclosures or shorts during the troubled times of 09 through 2011 there? 50%. Pretty high. 1.17. Well, that is up from 0.6 and 0.7. And you know what? I know that's a little small, so let me do this. There we go. So percentage of all sales that are either foreclosures or shorts, 1.17. That is up. It is still below 2020 levels. And you guys can really see kind of what this has been doing, obviously. There was a foreclosure moratorium, and moratoria definitely have a visible impact on the market. Yeah, so 1.17 still below these levels, but it's definitely something that we're watching. What's next? FHA, just a little bit of a financing update, guys. I know we talked cash, but I want to talk FHA versus conventional a bit. When the market crashed in 08, 09, who had to come to the rescue and backstop mortgage markets and provide liquidity? It was the feds, right? FHA. So look at how much FHA financing or lending, I should say, grew. I think it's good that it was this low here because the private sector was taking up that risk, as they should be, right? Not taxpayers. Seeing a little bit of an uptick here, 8 down to 7, kind of back up to 8. But let's take a look at conventional. Conventional loans, that's where 80% of it, 80% of those, in that period were conventional, right? Just kind of private bank loans. Looks like they hit a peak of 75%, 74% before they've reversed a little bit. What do we say? Oh gosh, did I forget it? Once is a coincidence. Wait, once is random, twice is a coincidence, 3 times is starting to look patternistic, and 4 times you might have. I think you've got something there. So we've had what, 1, 2. So kind of coincidental maybe. So we're looking for some confirmation. If we see another year or another quarter or 2 like that, I think that'll grab our attention a little more. Lessons learned, guys, percent of adjustable loans. Look at this, 0405, almost 1 in 3 loans were adjustable. Lately, 3, 4, 5%, right? So it looks like we learned our lesson. We took that medicine. Difficult to swallow. Always has that nasty cherry flavor. All right, December median price by property type. This is a repeat. I don't know why I have this. Forgive me. Month supply. So here we go, guys. Here's single family at 1.9 months. Here's your condos at about 2.8, and there's your townhomes at 1.8. Technically, not by much. Townhomes are the tightest market, right? With supply the lowest relative to demand. Condos are definitely not a buyer's market, but the closest toward a balanced market, right? Of any segment, it's the most balanced, I guess, relative to these other two. Pendings, new construction, up 11 1/3%, guys, right? That's noticeable. Well, builders aren't clinging to their interest rates like owners of existing homes are, right? Builders aren't clinging to their interest rates, and they actually do have some supply to sell. So existing sales down about 18%, while new home sales actually up 11. So again, opposite directions there. Looking at the price points, looks like builders are easing off a little bit. Maybe they're not finishing a bonus room or not finishing a basement, or maybe they're doing some 4 beds instead of 5 beds, or 3 baths instead of 4 baths, whatever it is, or maybe more affordable materials or flooring or something. So 350 versus about 475. You guys can see the difference. Existing prices flat. New home prices actually down a little bit, which is interesting as demand has risen. Typically, when you see demand rising, you'd think price is up. But what about the type of product? If the product is smaller, a little bit more affordable, 1 fewer bedroom or whatever, sometimes something else can happen, and that's what we're seeing. Luxury. If this slide and this slide don't scream luxury to you, I don't know what does. Million plus, what's happening up here? So this is annual, so about 1430 down from 1540, and pretty much tied up with the same 1430 level in 21. So just look at this increase in luxury activity and million plus activity. What do we say sometimes? Imagine this was 750 and this was 1500. This market doubled in 2 years. You don't really see that much, right? This segment, this luxury segment, doubled in 2 years, up a hair, down a hair, so kind of flat, but we're watching it. So let's keep watching that. And then November, just kind of teasing out November, because sometimes a month can look different than the year did as a whole, and vice versa. So actually, we are seeing growth as of November, right? We're kind of back to growth. Not quite that level, but we are back to seeing a plus sign, which is interesting. Do Minnesotans say that a lot? That's interesting. We don't want to say that's bad or that's concerning, so we want to say something nice, like that's interesting or something indifferent. Anyway, percentage of sales occurring in our 2 beautiful cities of Minneapolis and St. Paul. Condo boom, anybody? 09, right? Look at how much of that was happening in downtowns and cities. Pretty interesting what's happened since. Look at the increase, right? Here is COVID, March 2020. See urban market share declining a little bit and then up and fairly flat, down a little, but pretty flat. And actually, so what, about a year and a half ago, a little more, The percentage of all sales happening in the two core cities was about the same as it was 7 years prior. So yes, we are down from that a little bit, but I think this would be surprising to most people. Sticking on the city, here is our uptown, Calhoun Isle, Camden, northern side of North Minneapolis, central downtown, Longfellow, North Loop, Elliott Park, Mill District, what I meant, Ventura Village. Don't forget Ventura Village. Longfellow, Southwest, right? Southwest, always our high flying market at 500,000 prices up. Wow, 13.5%. Phillips, one of our more affordable markets, 107,000, down 42%. Careful here, you guys. Sometimes there's one sale. So there might have been one sale for 187 and then one, small condo for 107. So be careful here. Sometimes you really get into small sample size. And then just for fun, let's throw in the Big Lake, Deep Haven, Excelsior, Tonka Beach. Here's our friends in Wayzata and Woodland. So a couple places had no sales. So you've got zero, you've got no price if you have zero sales. I'll take things that are obvious for 800, Alex. So then look over here. There's your 2 point. So this is in thousands. So 2.1 million, 2.1 million, 1.8 million in Tonka Bay, 1.2 million in Wayzata, 1.4 million in Woodland. Those are very different price points than our beautiful Minneapolis neighborhoods, aren't they? All right. So every market's different, you guys. Moving time, moving day. Are we moving? Where are we moving? A couple years ago, we were moving 50 miles away, 50. Before then, the median was about 15. So some were doing 10, some were doing 20. Some were doing half a mile and others were doing 1,000 miles, but that all kind of averaged out or medianed out. That's not a thing. That reached a median of about 15, right? That reflected a median of 15 years, up to 50 as people were really relocating from San Francisco to Boise, from Seattle to Tucson, from Boston to Charleston. I don't know. I'm making some of this up, but there definitely was this relocation. And remember, people could work from almost anywhere, and many still can. We have seen that come down, but it is still a little bit elevated. So here I go again. I thought that was interesting. Still elevated. So let's keep watching that one moving forward. Time check. Oh, we got to keep moving here, you guys. So month supply of inventory, Minneapolis in blue versus suburbs in orange, right? The city's always been a hotter market with a tighter balance of supply and demand. And then something changed. Something changed in 2020. It looks like we're kind of sinking back up after we had this gap. It looks like the city and the suburbs are reconverging, if you will. Days on market, suburbs. Look at the gains in the suburbs, right? Suburban listings taking 80-90% more days to sell. In the city, only about 30% more, which again I think might surprise some people. And then change in price. Cities are always going to have more dramatic swings, right? So prices lower there and then higher there, and so you'll always see kind of more dramatic movement. And by the way, guys, these are trend lines, so you can see the raw data behind it, and you'll see there were a few months where we hit it, not for the year as a whole, but there were a few months where we were negative. But it is nice to see things kind of leveling out. It looks like we're kind of starting to curl back upwards, which is, of course, encouraging. How deep is the mud? One of my favorite images. You ask someone, the mud is neck or shoulder deep. You ask someone else, it's only ankle or knee deep. Case-Shiller. I don't always love the Case-Shiller numbers for reasons I think you guys know. We've got the MLS data, which is a gold mine of data, of real estate data. So year-over-year change in price going back to 16, pretty normal price growth, right? 5%, you guys. Here's COVID, pretty abnormal price growth of 20%. Some regions having 35%. I believe that's Phoenix and Miami, or maybe Tampa. So you'll notice some were above the curve and never got zero, never got negative. and others did get negative. Let's break that down. I think you guys are going to like this. Here's our cold cohort, our winter states or winter regions. What's going on with these guys? So New York, Chicago, DC, Boston, Motown, Minneapolis, and Cleveland rocks. You guys can see, like, it looks like DC was the only one of these markets that just barely kissed below zero. It just barely went negative. But all these other regions didn't go negative, right? They never actually saw price declines per the Case-Shiller data. How about our warm cohort or our hot cohort? Here we've got LA, Dallas, Phoenix, San Fran, Tampa, Denver, Vegas. All of these guys were below zero. All of these regions saw price declines. So it really does seem like there are climatological, meteorological factors. Climate seems to be a factor. Climate seems to be a little bit of a factor here. Oh yeah, what is this? Let's see if I was right. Tampa and Phoenix. Sure enough, guys, Tampa, 35%. So, apparently the higher you climb, the harder you do fall. I guess, sort of. Zonda, our friends at Zonda, I think they do good work. They've got us pegged near, toward the end of last year. They have us categorized as a significantly overperforming market. You guys can see where you'll see more red and more yellow, but overall, Midwest, we're holding our own. We're really holding our own. And then the Southern Atlantic region, stronger than the Northern Atlantic seaboard, if you will, than the kind of the East Coast, kind of upper East Coast, if you will. How's the water? Cold, really cold. How's our boy Jerome? I think he's doing okay. He might dispute that comment. What's going on with rates? Let's take a little bit of a step back. The year here is 1982, and 30-year fixed rates starting at 18% with a point. 16 3/4 with 5.5 points. When you hear millennials complaining about 6.5 or even 7 or even 8%, remind them. I know some of you remember the early 80s. I'm sure some of you got a loan originated at 18%, and hopefully you've refied since then, hopefully. If any of you know Jim, feel free to page him. There's his pager number. Oh God, guys, we're running out of time. We got to keep trucking here. 30-year fixed rate, you guys can really see the history. There's your 1980, there's your 18%. Declines for a while, there's your COVID lows, and there is the Fed really hiking that federal funds rate, which trickles through to the 10-year and of course to the 30-year fixed. Won't dwell on this one too much. This one only goes back to 2000, and check it out, you guys. Sure enough, highest levels since 2000. I'm not paying 7% interest on a mortgage. Guess what? Rent is 100%. All right, what's going on with payments, you guys? I got to give credit to Todd Walker. I don't know if he's on, but saw him last night. I got to give credit to Todd Walker. He's the first person who said to me, this is a monthly payment business, right? This is a monthly payment business. I knew it because when I bought my home, you start reverse. I say, I'd like a $2,000 a month payment. You tell me how much home I can afford. So it's kind of reverse engineered. But just taking a look at this, you guys, over 3 years, the typical payment on the median priced home, using some assumptions, is up $1,100 a month, over $1,000 in payment per month, right? So 13 grand a year, pretty significant, pretty significant. When we look at that as a percentage of income, it is at all-time highs. Well, excuse me, catch myself there. It's at the highest level since at least 03. I'm confident saying at least 2000. I'm not confident saying highest level since the Great Depression or since the 70s, but I will say, 26% of pre-tax income to housing compared to 24.8. It's not as much above that level as you thought, probably because incomes actually have risen, more than you might have thought. When we factor for inflation, a little bit less so. Median age of home buyers, here's your first-time buyers here in blue, right? 30-year-olds used to be first-time buyers when homes were cheap and rates were low. Then they had to wait till 31, then 32, then 33, then 36, and a little bit encouraging that we've come down a little bit to 35. Others aren't that interesting. Median seller tenure, 10-year, 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 10-year. 6 years. We used to move every 6 years, 5 to 7, 6, right in the middle of 5 to 7. Something changed after the world changed in 08, 09, and now we're staying in our homes a lot longer. 10 years. Look at the dip to 8 when everybody moved. Everybody was moving about 50 miles away. And then we're back to 10 years as we feel that handcuff, the golden handcuffs, and the lock-in effect where we feel locked into our mortgage. Yeah, median down payment, I don't know. This is a little interesting. We won't spend a ton of time here. 8% down. That actually is the highest level in a few decades, which is interesting. Repeat buyers about 20%. They can get there, you guys. They've got 100 grand, 200K in equity from the first home, whatever it is, 75, 150, whatever it is. Millennials, what's going on with you guys? What's going on with us, I guess? Percentage of all buyers that are first-time buyers, 50% when home prices were on sale and rates were low. This was pretty discouraging to see this 26%. That was a pretty low number, pretty sad. And I think some did worry that would this trend be the kind of the new trend? We've recovered a little bit, 32, so we're kind of a little bit back toward where we were. But let's watch this moving forward. So, for a long time, it was 40, 42%. And this has definitely been on the decline, minus a few kind of up and down bumpy years. Millennials sort of betting on the housing market to collapse. Come on, collapse, because they think that's the only way they're going to be able to buy a home. The truth is, millennial homeownership rate, and I know this is a few years old, millennial homeownership rate is actually the second highest of any metro here per NAR. So we're sandwiched between Grand Rapids and Cincinnati, of all places. Our friends in St. Louis and the Steeler fans, you guys can kind of see they're pretty close to us as well. So guys, millennials here are pretty high earners. They're pretty well employed. They're pretty eager to own homes. And this is a good thing that's, I think, really boosting our region and helping us. We'll skip that one. It's just not that interesting. This is always a funny one. They say economists have predicted 17 of the last 3 recessions. I'd tell you an econ joke, but I think there's just not enough demand for it. In the short term, I actually do like this one. In the short term, the stock market is like a voting machine, but over the long run, it's like a scale. It's a voting machine because I wake up today and I read a nasty headline about the Houthis in Yemen, Israel, Ukraine, Taiwan, you name it, too many to mention. And so, I don't know, I'm going to sell some stock because that's my vote. I'm feeling bearish. That's my vote. Over the long run, right, the market actually values fundamentals and looks at earnings, right, margins, sales, revenue, all that stuff. So in the short term, it's like a voting machine where I like this or I don't like this, but over the long run, it's more like a scale. And I really like what Lauren said about this. Mortgage rate changes will have an impact in the short run, while job growth, high quality, well-paying jobs really have a steady impact in the long run. And that's what leads to a healthy, sustainable market. So I really do want to make that clear. Let's see, guys. 2 minutes. All right, we're going to speed through a couple. Lowest unemployment rate as of November. Who's got the second lowest unemployment rate of any major metro? You're sitting in it. Probably. I think most of you are here. You're sitting in it, right? We're between Baltimore and Birmingham, the 2 Bs of all places. So we're actually doing pretty well locally. I've shown this one a bunch. You guys won't dwell on it. People think home prices always fall during recessions. They're wrong. They don't. Actually, 4 of the last 6 recessions, prices actually rose from, when we were coming out of recession. 08, of course, a counterexample because that was a housing-caused recession. All right, guys, stick with me. 2 minutes. I've got 3 real quick forecast slides here. Estimated home price performance, December to December, and this was forecast just a month or 2 ago. So this year they're thinking about 2 1/3, right? 2.3, 2.4%. Next year, more like 2 3/4. Then we get up to the 3.5s and the 4s, and 4+, which makes sense to me. forecast for year end last year. Forecast for year end last year, so they averaged out to about 3.3. We ended up being about half that, but again, we're not impacted by California, New York, and similar places. But here's what they're kind of thinking about for this year. Average of all forecasts 1.5. Last year, again, about 2.8. This is interesting though. NAR is the only one that whose forecast has increased. Mortgage bankers and the government folks thinking price growth will be lower this year than last. NAR thinking it'll be about 7 times as strong, but only 0.6% stronger. So sort of a little wonky there. All right, second to last slide, guys, promise. Total home sales. So we just looked at prices. Let's look at sales a little bit. Prices matter, but you know what else matters to you guys? Dollar volume. So it's not just prices, but it's the sales volume at those prices. And that's what really feeds into your GCI. Average of all four, they're thinking up about 8.5%, which makes sense. I think if rates do hit the high fives, mid to high fives, I think we could easily do over 10%, even 12%. Remember, even a 20% increase, you guys, is not going to get us back to COVID levels. But it will kind of bring us off the floor a bit. So Fannie, flat, mortgage bankers up about 6, and then NAR up, there you go, 14, 15%. So pretty interesting. I will wrap up by saying most agents know what's happening. Good agents understand what's happening. But great agents can really explain what's happening and convey that to your clients to really provide the value and make sure they're making the best decision possible for them. I cannot thank you guys enough for sticking around with me for an extra minute. And I will hop to questions real quick. Dima, what % of homes with mortgages are assumable? I do not have that figure, but it's pretty much only government loans, right? Do banks do assumable? Not that I'm aware of. God, I wish they did. Anything else I'm missing in chat, guys? Let me do a quick scan.
Nothing but praise from what I see, David. I will just kind of close things off here with 2 quick things you should all be aware of. One, obviously, we have another monthly housing market update. This one is on February 15th. Same time, also on a Thursday, also virtual. I just put that link in the chat for everyone. And I will be remiss if I don't let it slip out that our NAR chief economist, Dr. Lawrence Yoon, will be speaking live here in St. Paul on March 4th at the Realtor Day at the Capitol 2024. If you have not already registered, we don't normally plug MNR stuff going on, but this is one of those times we absolutely have to. For all of the people who stayed through this webinar, you will certainly appreciate it. I'm putting that link in the chat as well. That is not our registration, that is Minnesota Realtors, but you all are Minnesota Realtors as well as MAR Realtors. So please go ahead and join us. David and I will both be there asking questions of Lawrence when he's not on stage. We'd love to see you there as well.
Yeah, please join us.
And with that, please fill out our post evaluation that Alicia kindly keeps putting in the chat. Thank you to Alicia. Thank you to all of our attendees. And thank you, David. Happy to have you here giving us pearls of knowledge as always.
Awesome. Always enjoy doing it. Feel free to follow up with us, guys. Stalk us on our website. You know how to reach us. Any specifics, any questions, feedback. We really, thrive on feedback, constructive or positive. I guess we get a lot of positive here, but anything you guys would like to see moving forward, talk to us about it. Any anecdotes you guys are seeing, something concerning a return of escalation clauses or appraisal gap, something like that. Jackson and I really do rely on you guys to feed that to us because we're not out there seeing it every day. We see the data come in kind of after the fact. So please do try to keep us, in the know with that stuff as you see it.
All right. Stay warm, everybody, and we will see you next month.
Thank you. Thank you.